on here. So we talked about our adjustments. So the first one is our educator expenses. So these are our teachers, our counselors, our principals that are working at the elementary, middle school, high school. Okay. Okay. So that's working at our elementary school, middle school, and high school. In order to qualify for the educator expenses, they have to have completed at least 900 hours for that calendar year. So the thing about for 2022 for the educator expenses, it is up to now $300. In the past, it was $250 for the taxpayer and her spouse if both of them were educators. So if both of them, they could now make an adjustment of $600 on there. But they cannot deduct more than their expense. So what are qualifying expenses? These are ordinary necessary expenses paid in connection with their books, supplies, equipment, which can be computer equipment, software, and other materials for the classroom. These expenses include amounts paid or incurred for personal, for the PPI. So it could also be for the COVID. It could be hand sanitizer. It could be masks or face shields on there. And so this is not for any individuals that are homeschooled. So this is the first adjustment on there. So definitely when we're looking at the 13614C and we see that someone is a, maybe they put on there their occupation is a teacher, then we can ask them, and then definitely if they check the yes or no on there. So even if they say they have 500, if we put 500 into tax layer, the tax layer is only going to give them the max, which is the 300. So that's the adjustment on there. So this is up to 300 for the taxpayer and spouse if they're both educators. So the next one is our self-employment tax. So this is we saw when we were completing the business income. Once you've input their business income and expenses in tax layer, it's going to do the calculation for us. So what it is, because our self-employed, these sole proprietors, they have not paid, there's no taxes coming out of their income. So they're receiving the gross. So the only way that they remit taxes is if they do their estimated, quarterly estimated taxes. That means they're estimating how much income they would make for the year or the quarter, and they estimate their taxes, which they could probably do maybe about 15%, and they send that to the IRS on there. But because they are sole proprietors, they are responsible for the employee and the employer section of the taxes. So tax layer is going to take half of those taxes and is going to calculate an adjustment for it. So again, it's taking that net income, that net profit that they have, and it's going to do the calculation. It starts off with the 92.35%, and then from there it does the 15.3%, and then half of that they're going to write off as an adjustment, and you're going to see that reflected on the tax return. So all you need to see is when you see an adjustment in that line item, that is half of the employee-employer share that they're doing an adjustment for on their tax return. And again, TaxSlayer will automatically compute this for us. So there is also the self-employed health insurance deduction. So if we have self-employed individuals and they have health insurance through, like we would say, through the marketplace, we can only calculate this if they did not receive a subsidy or they're paying for their insurance out of pocket. We can go into TaxSlayer and put in their health insurance deduction. You can input this on the adjustment side, so their total premiums that they've paid for the year, or we can put this on the Schedule C where it asks for their health insurance. Now, if they have a W-2 job, we cannot put the premium listed here on there because the premium through their W-2, that would be something totally different, not reflected on the tax return. So this is for self-employed individuals. If they got health insurance, again, through the marketplace and they did not receive a subsidy, so that premium tax credit, if they did not receive that at all on that 1095A, or if they're paying for health insurance like out of pocket going directly to an insurance company. Again, so you have two ways that you can enter this when you're directly on the Schedule C and putting those expenses, or on the adjustment side, but you don't want to duplicate that information. So the next one is the penalty of early withdrawal of savings. So we talked about this when we talked about the 1099 INT, that interest form on there. And so we talked about when you get one of these tax forms that you enter everything that's listed on that tax form. So on the income side, we already took this form and entered everything. So even if we saw something in box 2, the early withdrawal of penalty, we've already taken care of it on the income side and it moved it over to the adjustments on there. So when you get to the adjustment screen, you do not have to go back to this form and input that early withdrawal of penalty. So this is typically those individuals, again, we said they have a CD. It matures within a certain period of months. And if they decide that they want to cash that CD in early before the maturity date, they are forfeiting some of that interest that comes back. And so that's that penalty. And so that's an adjustment that gets deducted from their income. Next, we have alimony. I won't have to go into this too much, but the alimony, these are for those individuals that had a divorce decree prior to December 31st, anyone December 31st, 2018, where it allows the person who is paying out the alimony to do an adjustment on their tax return. And so in order for those payments to qualify as alimony, it cannot be considered child support. They are required by a divorce or separation, a decree. The payer and the recipient, they're not filing a joint return, and the payment is in cash or check, or cash equivalents on there. And so this means for the alimony, for those individuals that have a divorce decree that they're paying prior to December 31st, 2018, the recipient includes the alimony as income, and the payer, they get to do an adjustment. And so the thing on the tax return, it does ask for the recipient, their social information that's listed on the return, that we have to put that there. Now we have our traditional IRA. So these are also coming on our form 1099-R. And so we talked about a little bit, again, there's two types of IRAs. There's a traditional and the Roth. So the traditional, you do get a tax benefit on your tax return, which is an adjustment. So you're able to do a deduction for the contribution amount that you've made for the year. The Roth IRA, it is after tax. So the Roth IRA, there's no tax benefit on the tax return, but you would contribute to your Roth, and any of the interest that you earn, it's going to be tax-free. So when you withdraw from your Roth, even that interest you're not having to pay taxes on. It's just reflected on the return just for informational purposes. So your traditional is treated just like a 401k. It's pre-tax. So taxpayers may be able to deduct some or all of their contributions to the IRA depending on circumstances, which is depending on if they participate in their retirement plan. But again, for our VITA program, typically most returns that we complete, their income is under $60,000. On there, we do have some where their income is a little bit more, but for our individuals, because of that income range, they would still be able to qualify to contribute to the traditional or the Roth, and they would still be able to get the adjustment deduction on their tax return for their traditional contribution. Generally, amounts in the IRA, including earnings and gains, are not taxed until distributed. So that means they're putting all of this money in there, again, pre-tax, so they haven't paid any taxes. So when they get ready to take a distribution, which we said we want to wait until we're 59 and a half, that's when we're taxed on it. So we want to wait till we're 59 and a half, so we're just reporting it just as tax. We don't want to pay a penalty. The penalty is before you reach 59 and a half, but there are some exceptions. contributions may be eligible for the retirement savings contribution credit. So there is a credit within on the 1040 to motivate people to contribute to the retirement account. This is also for those on their W-2. We talked about that box 13, and it says a retirement plan, as well as box 12. There could be a code D or G. I think there are some other codes depending on what type of industry or individual is in to show how much they contributed to their retirement plan, and TaxSlayer will give them a credit for that. It's up to 50% of the contribution. In order to participate into the traditional IRA to give to that, individuals must have taxable compensation. So you must have income. So if a person did not work that year, does not have any income, they're not able to contribute to the traditional IRA. Now, if it is a married, filing joint company, the taxpayer works, the spouse doesn't, they're still going to use the income jointly for the spouse. So it's going to be going based off the taxpayer's income that they're able to use for the traditional. Contributions must be made by the due date of the return, no extensions. So this is good because individuals now for 2022, they have until April the 18th of this year to contribute to the traditional IRA for the 2022 tax year. So someone could come in wanting to get their tax return done later this month or early next month, and maybe we've determined after going over the tax return, maybe it will be beneficial for them to contribute to the traditional IRA, maybe to get some of their tax liability down. Well, they still have time, and I can input their contribution on the 2022 tax return. So they have until April the 18th to make that election for 2022. They just need to go to their financial institution, open it up, and just make sure that they let them know that I want to make this contribution and I want it to go towards 2022 tax year, not the current year. So they have up until, for this year, April 18th to do that. The deduction as the adjustment amount, you're going to deduct the lesser of the contributions or compensation on there. So you'll see at the bottom here, it says the max contribution is $6,000 if an individual is under the age of 50, or it's going to be $7,000 if they're 50 or older. So there's that additional amount for those older individuals that they can contribute. So if someone, all they made for the year was $3,000, then all they can contribute on there, it's going to be for their deduction, it's going to be $3,000 instead of the $6,000 if they're 49 years old, because that's where they deduct the lesser of the contribution or compensation. If it was a married, filing joint couple, and say they made $50,000, and if they're both, we're going to say 55, the taxpayer is the only one that works and the spouse doesn't, then they're able to contribute the $14,000, $7,000 for each of them because it's going based off the compensation of the $50,000. And there is no age limit on there. So that was something that was changed. There is no age limit to contribute to the traditional. It used to be 70 and a half for the traditional and no age limit for the Roth. So we have our health savings account. So we talked about this health savings account also on yesterday. We talked about it on the income side, but here's the adjustment side. So an HSA, it's a tax-exempt trust or custodial account that a taxpayer sets up with a qualified HSA trustee. Distributions from a HSA are non-taxable if the funds are used for qualified medical expenses. A taxpayer must be an eligible individual to qualify to contribute to an HSA. So I would say if you guys are getting ready to, go out into the workforce, you're looking for jobs, these are definitely good tools as you're going through the tax program. You want to find a company that has a retirement plan. Maybe they have a HSA plan that have all of these benefits with your compensation package, because these are just preparing you for later on in the future. on there. When I started for the 401k, definitely finding a company. A lot of companies match now. They just did a provision. I don't know all the specific details, but making a lot of companies opt in and individuals opt in, where you're going to automatically start to put money towards your 401k. And you at least want to put money in there up to what they're going to be matching. Also, the HSA is good. You're young. It's a plan that you're saving for your medical expenses. You never know what the future holds when you get older. Typically, you start to go to the doctor more. But these are also pre-tax funds, but they're set aside for medical expenses, medical, dental, vision expenses. So it's another great way to have like an extra savings account or 401k account. In order to have the health savings account, you must be covered by a high deductible health plan on there. So typically maybe your deductible has to be, I think for individuals, more than I think 3,000 or close to 4,000 for individual. And I think it's around about 6 to 7 for a family plan. So high deductible. You guys are young. Like if you're not really going to the doctor a lot, having a high deductible plan would be good, and then you can have this HSA. You can contribute funds to your health savings account. Have no other health coverage except for those allowable under other health coverage, and that's in publication 969. So just making sure you just have that one high deductible plan with your job. It doesn't allow individuals to be covered in Medicare on here, so those are for those older individuals and cannot be claimed as a dependent on someone else's tax return. So the HSA, again, is very similar to a 401k. You're putting pre-tax funds into this account. For the single individual, it's up to $3,650 for the tax year on there that you're able to put in annually on there. And the money can just sit there. You can also invest the money. And so the way you're able to use it, if you go to the doctor, you're able to use those funds for those expenses because it's already been pre-taxed. You did an adjustment of your contribution on the tax return, so that's your adjustment on there. And as long as it's again used for medical, dental, vision expenses, you're not having to report that income as you're not having to report that distribution as income. So we talked about those. You get like a little debit card. If you use it for anything other than those three, then you have to report it as income, and you're having to pay a 20% penalty on the distribution. So this is on the intake sheet. We ask them if they have a health savings account. A lot of times we get people where they confuse their flexible spending account. There's also one other type of medical account, but we really don't see it. But a lot of people have the flexible spending account. The flexible spending is money that you have to come out of your paycheck, and it goes into like a pot. I think there is maybe like your group uses it, but there's a certain amount. With that flexible spending, you have to use that amount annually. You have to have exhausted that. I think they only allow maybe 1,000 of it to roll over to the following year. So that's the thing about a flexible spending account. There's a certain amount that you have to use by the end of the year. So those are typically for individuals that may have children. They know they're going to go to the doctor. They know they're going to have expenses, and they're going to opt to use the flexible spending. The HSA account, it stays with you. Even if you leave your job, it's your account. It's not connected through your job. It's connected through the financial institution. Your employer can contribute to your HSA. You can contribute to your HSA, and you can have family members or friends contribute to your HSA up to the threshold amount. So if somebody made contributions to their HSA, they're going to receive Form 5498 SA, and it's going to have the total contributions made in 2022. Now, for those individuals that their employer is contributing, typically your employer uses it as already pre-tax. Because it's already listed as pre-tax, you will not get the adjustment on your tax return because it has already been adjusted for you on your W-2. But you don't have to make those contributions directly through your employer. You can actually go directly to the financial institution and make those contributions, and that's where you get the adjustment for. So where do we go and input the health savings account information into TaxSlayer? So again, under the federal side, when we see adjustments, we're gonna look for that form 8889 health savings account. We're gonna pick who the form belongs to, if it's a taxpayer or spouse, and both of them can have an HSA plan. So these are, both of them can have plans, and if they do, we would have to do this form twice. So who the form belongs to, it's gonna ask for the type of coverage. Is it an individual plan or is it a family plan? On there. Also, what are the contributions? It's going to tell you, do not enter in the amount that's listed on the W-2. If you see a W-2 and you have box 12 with a code W, that shows the HSA contributions. Even though the employee made them, even though we made those contributions, it's going to be treated as the employer contributions. So we do not want to add the amount that's listed on the W-2, box 12, code W. These will be any additional HSA contributions that were made. So if that form 5498, if it has the same amount as the W-2, we're not going to enter anything on the contributions. Then the number of months that they were an eligible individual. So how long was that employee, how long was a taxpayer or spouse employed at that job? If they've been there for years, then we could just go ahead and put 12. And then this other part is going to be out of scope. And we're going to see for the 2022 contribution limits, for a family plan, a person can contribute up to $7,300 to their HSA. And for a self-only, it is $3,650. They can add an additional $1,000 if the owner is 55 or older at the end of the year. So they do have these age phase outs where they allow them to do additional contributions. They're called catch-up contributions. So this is the HSA on here. This is the 1099 SA. So this means if anybody actually used their funds in their health savings account for the year to pay for any medical, dental, vision, or any type of other expenses, if they pulled anything from their HSA. Their form, we're going to look for what is their gross distribution. Typically, the distribution code is just the code 1, and we're looking for the HSA box being checked. So those other two, the Archer MSA and the MA MSA, those are out of scope for us. We're just focused on the HSA. And all we have to do is when we see the gross distribution, all we're going to ask them is, did you use your health savings account? Did you use it for medical, dental, or vision? If they said yes, then that's all we have to worry about when we get to the screen for the distribution side. We're just going to put the same amount, that number in there again for the medical, for their distribution, that they use it all for medical, dental, or vision. A lot of the comments that I get is that they only allow the HSA card to be used just for those purposes. So on that same screen in TaxSlayer, we get to the point where it says distributions. It's going to be the total distributions received for the year from all HSAs. We're going to input that from that 1099 SA form. And then you're going to see also, of those distributions, what was used for qualified medical expenses. On there, if it's the same amount, all you're doing is taking that amount from the top box and putting it into the second box. That means they don't include or report any of it as income, and they're not paying any tax on it, any tax penalties. So then we get to our student loan interest deduction. So this was the maximum benefit is up to $2,500. We probably won't see too many of these. It comes on Form 1098E unless somebody has private student loans. So ever since COVID, there's been a pause on student loans. So there's been a 0% interest. So we should see a decline into the student loans. Student loans, you're supposed to start back paying them back, I believe, in August or September. But with the Biden administration, with them trying to do the public service loan forgiveness, with them trying to waive somewhere from 10 to 20,000 for some student loans, they actually are in court or going to court about that. So there's still the extended pause. So we should not see too many people that have student loans again, unless it is for private student loans. So again, the maximum benefit on a tax return is $2,500. Someone could have paid more student loan interest for the year. Even if it's $6,000, you can put $6,000 into tax layer. It's only going to give them the max, $2,500. So what are the loan qualifications? The taxpayer must be legally liable for the loan. It must have been taken out solely to pay education expenses and cannot be from a related person or made under a qualified employer plan. For the student qualifications, the student must be you, your spouse, or a person who was your dependent when you took out the loan or would have been your dependent except you were a dependent or had gross income over the exemption amount or filed married, filing jointly. They were enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credential. You can deduct interest paid during the remaining period of your student loan, and the amount of your deduction depends on your modified adjusted gross income and filing status. So again, married filing separate, which is out of scope, they will not be able to take this adjustment on here. But again, with our VITA program, everyone should qualify with the filing status for what is listed on their statement up to the $2,500 on there. So this is also a form we're not requiring that they would have to bring in order for us to start on their tax return. They could pull up their student loan account while they're sitting in the chair and we could put that amount in. Now we do ask to see the form because this is only the interest component, not the principal. So if they tell us they're paying $150 a month, we're not going to put in there 150 times 12. We're just needing the interest part of it. So we want to look at that 1098E. And here's this form right here. So if they bring it in, this is where we're looking at what's in box 1. Or they're going to pull it up on their phone and they can give us that amount on their, pull it up through their servicer portal. So we're to a poll question. Stan, an unmarried college student working part-time, earned $4,500 during the tax year. What is the maximum amount he can contribute to an IRA? Correct. It's going to be the $4,500 because that is his taxable compensation. Bob and Carol are married and both are 55 years old. They both work and each have a traditional IRA. During the tax year, Bob earned $2,000 and Carol earned $50,000. If they file a joint return, what's the maximum that Bob can contribute to his IRA? That's correct. On there because they're doing a married filing joint return. Okay, we're going to go into deductions. And after we do the deductions, then I think there would be a break coming up. So this is in tab F. Do y'all have any questions about adjustments? Okay. So deductions. There's like the two main deductions, and then we want to focus on the standard deduction. So we finished up our adjustment. So we have our income minus our adjustments, and then we're going to minus these deductions. So as you can see, we're working down to help the tax client reduce their income. So the goal is to see what adjustments or deductions they qualify for to reduce their taxable income. So we have the standard deduction. So this is the allotted IRS amount given based on a filing status. Deductions are subtracted from a taxpayer's adjusted gross income. So income minus adjustments equals AGI, adjusted gross income. Then from adjusted gross income, we're going to subtract the deductions. They reduce the amount of income that is taxed. Most taxpayers have a choice of taking a standard deduction or itemizing their deductions. When taxpayers have a choice, they should choose the type of deduction that results in the lower tax. And right now, we're going to see most individuals, they're going to have to take the standard deduction. So there was the Tax Cut and Job Acts that was implemented, and it goes up until 2025 tax year, where it increased the standard deduction. It almost doubled the standard deduction. So it did eliminate a lot of people from being eligible to itemize, and we're going to go just a little bit into itemized deductions. So a standard deduction is for most taxpayers, it's a set dollar amount based on the taxpayer's filing status. An increased standard deduction is available to taxpayers who are 65 or older or blind. There are limitations on the standard deduction for taxpayers who can be claimed as a dependent on someone else's return. Itemized deductions allow taxpayers to reduce their taxable income based on specific personal expenses. If the total itemized deductions are greater than the standard deduction, it will result in a lower taxable income and lower tax. So we have a choice of either taking the standard or itemized. Again, like I said, most of us are going to be taking the standard deduction now just because it, over recent years, the tax law has increased the standard deduction. It doubled the standard deduction. So this is a set given amount for each filing status that the IRS has. This one requires taxpayers to have expenses. You have to have certain expenses that are going to be greater than the standard on there. We're going to highlight just those dollar for dollar expenses to see if it'll give them, put them over the standard deduction. So for the standard deduction, and it increases incrementally each year for inflation. So for a single or married filing separate return, the standard deduction is $12,950. So this is for a single individual who's not claimed as a dependent. Their standard deduction is $12,950. So that's a already set amount that it's given to you. So your income, you made $20,000 for the year. Then you didn't have any adjustments, but you get this standard deduction of the $12,950. So you're only paying tax, your taxable income is just the difference. You'll see married, filing joint or qualifying survivor spouse with dependent child, which is that qualifying widow, widower. You'll see their standard deduction is $25,900. Head of household, $19,400. So this is reducing their income. So it means what they're paying tax on is going to be a lower amount. Now we talked about those individuals who are dependents or maybe they're 65 or older. They're going to get even a higher standard deduction. So we go to this page. So this is in your F2. So you see if we have somebody that's single and say, for example, if they are 65, we're going to go single and we're going to look at one. So they have one exemption, one additional qualifying. We see their standard deduction is the $14,700. So their standard deduction is even higher. So that means it's going to reduce their income even more. Well, say, for example, that single person is 65 and they're blind. So we're going to go to single and two. Their standard deduction is $16,450. Now, you don't have to worry about what a person's standard deduction is because, again, when they fill out that intake form, that's already been taken care of. When you go into TaxSlayer and you enter in their date of birth, you enter in their filing status, that's already taken care of their basic standard deduction. Then there's also on the intake sheet, it asks if someone is blind. If they're blind, again, we've selected that under the basic information in TaxSlayer. So it is already taking care of this standard deduction for us. It's going to do the filing status. It's going to do if there's any additional qualifying. So if we had a married filing joint, I've actually had this at my site, a married filing joint couple, and a married filing joint couple, and they both were blind on there. So that means they got 2 exemptions. So their standard deduction was a $28,700 on there. But I didn't have to figure that amount out. TaxSlayer did that for me. So this is just the additional chart that it'll figure out for those individuals. And then also for those individuals who are claimed as a dependent, it's going to take a look at their earned income or unearned income. So if they have earned income, it's going to take their earned income and it's going to add the $400. So pretty much their standard deduction will be up to a single individual, which is at $12,950. If it is unearned income, it's going to be that $1,150 on there. So say, for example, if a single person, a single dependent, if they made $4,000 and they made that $4,000 in wages, it's going to take their earned income, is going to take that $4,000, add additional $400. Their standard deduction will be the $4,400 on there. So it still kind of evens out for those dependents. Definitely when it comes to, again, earned income. So income that they work for. Bless you. So then we talk about these itemized deductions. We may have just a few of them at our site location on here. But again, so we're going to use that single individual. Their standard deduction is already $12,950. And they say that they want to itemize. Their itemized deductions, it has to be greater than the standard deduction. So they need to find some expenses listed on here, and it needs to total more than the $12,950 for me to want to use that deduction on the tax return. The higher the deduction, the less taxes that they're being paid on. So these are some dollar for dollar, certain taxes paid, and it's limited to $10,000 on the return. So real estate taxes, property taxes. So we want to go for those people that are homeowners. And it's typically those new homeowners on there, typically not those individuals that are made 65 or older, are probably disabled because they have certain qualifying credits or adjustments on their taxes. Individuals 65 or older, they get a special tax break on paying their taxes. So they're not paying as much property taxes. So you can see real estate taxes or property taxes, then sales tax. So the IRS also allows us for sales tax. We don't want to keep all of our receipts for all the purchases that we make. So they do allow us, based upon your filing status, based upon your gross income threshold, they're going to estimate how much you would have paid in sales tax. Also, they will also allow you to do large purchase items. So if a person also purchased a vehicle, so that means they get the table amount for sales tax plus the sales tax on that large purchase. Then we have state and local income tax, but that's not for Texas. We don't have state and local income tax. So for a Texas resident, we would be looking at our real estate taxes for a homeowner and then the sales tax. So that's where I first lead when someone says they want to itemize. Are you a homeowner? Typically, if they're not a homeowner, they won't be itemizing. Then we have the home mortgage interest and the PMI. So again, for those homeowners, their interest. So we know that housing prices went up. People are typically, when you first get your mortgage, you're paying more in interest than you are in principal. So they receive a Form 1098 from their mortgage company, and we add that mortgage interest, also with those property taxes. We know also property taxes are increasing. So those could help them get over that $12,950 for a single individual. Then also gifts to charity. Anything that is a 501c3, this could also be churches, synagogue, temples, anywhere that a person goes to worship. They're automatically considered 501c3s. They don't have to apply for it. But also 501c3s like American Red Cross, St. Jude, people that give to those gifts to charity, these are dollar for dollar. Again, we would add up all of their amounts to see if it is more than the $12,950. We won't go into the casualty and theft loss. That's a percentage, but it has to be something very significant. Like if there is a tornado, something that damages maybe their home. But again, we also have to factor in their insurance payments. And then there's the certain miscellaneous deductions. So the biggest one is gambling losses to the extent of gambling winnings. So someone enjoys going to the casino. If they say they lost money gambling, well, did we receive a W-2G from them to show their gambling winnings? Because again, it's only losses to the extent of winnings. If we have W-2G forms and say they made $10,000, but they say they lost 12, we can only write off up to the 10 that they won on there. So all of this would want to be greater than the standard deduction listed based upon their filing status and their qualifying. So again, a single person, the $12,950, married, filing joint, or qualifying widow, widower, the surviving spouse, that $25,900, head of household, $19,400. So again, this is why we're going to see a lot of people that are just going to be taking the standard deduction. Okay, and the last one here is our qualified business income deduction. Again, this is automatically calculated for us by TaxSlayer. This is our sole proprietor, self-employed individuals. So again, it's for tax years 2017 before, so it's going to end with 2025 tax year. It is for pass-through businesses. So sole proprietors are categorized as pass-through businesses. A sole proprietor that reports a profit on Schedule C will be able to take up to 25% of qualified business QBI as a deduction on the tax return. So they have to have a profit. If they have a loss, they're not getting the qualified business deduction. And it's up to 20%. The calculation on Schedule C and the Schedule SC, that's the self-employment tax, are not affected by the deduction. The taxable income is not reduced below zero by the 20% deduction. And the 20% deduction is limited for higher income. But again, for our VITA program, we wouldn't have to worry about this being limited. But yes, if they have a net profit on there, and it's not going to reduce it below 20%. So for self-employed individuals, they're typically getting another deduction listed on their tax return. Again, this is for tax years 2018 to 2025. And again, TaxSlayer is going to calculate this deduction for us. And this is only for our sole proprietors, our self-employed individuals. So the taxable income that does not exceed the applicable threshold, the qualified business income deduction is the lesser of 20% of qualified business income or 20% of taxable income. So the qualified business income is reduced by the deductible part of the SC tax, the SC health insurance deduction, and by contributions to a qualified retirement plan. The deduction is claimed on Form 1040 and can be taken in addition to the standard deduction or itemized. So you'll see this listed on the tax return. There's a line item that has qualified business income deduction. And again, it is the 20% on there. So for our self-employed sole proprietors. Okay, so going to some poll questions. Roderick is 64 and blind. can he claim an additional deduction? So don't forget we had those deductions again for the standard deduction, and they have a higher amount if they are 65 or older and blind. So Roderick, he is going to get an additional deduction because he's blind. He hasn't reached the age yet, but he will get one for being blind. So he's going to get a higher standard deduction, more than the $12,950. Leticia died in May just before reaching her 65th birthday. Does she qualify as age 65? Now this one I know we didn't go over. We typically look at a person's age as of December 31st. So she is just going to still get the standard deduction. She's not going to get the additional amount because, again, it'll look at her age as of December 31st.